en la Reserva Federal, en los últimos mensajes que estamos conociendo. Saludamos a Jay Pelosky, founder in TPW Advisory. Jay, thank you so much for having us a few minutes.
Hi, Marta. Nice to see you again.
Jay, in Wall Street, we are seeing how Dow Jones and S&P are rebounding, and in the case of yields are retreating in this moment. Which is, from your point of view, the great picture of markets?
Well, I think things have been really quite crazy over the last several weeks, right? We've had very aggressive rate backups, certainly in the U.S. and in Europe. And then we've seen Japan not participating, right, with yield curve control in the PBOC, and China actually cutting rates. So we've had what we call a desynchronized rate environment, policy environment going on. And then in the last couple of days, we've had the UK enter the picture with a very disorderly bond market reacting to a very surprising mini budget from the new government there. So an awful lot of confusion, very illiquid markets. I've seen suggestions that the U.S. Treasury market, which traditionally is the most liquid financial market in the world, is as illiquid as it's been in over a decade. That's really pushing up the volatility. So Treasury volatility is close to all-time highs, and that's normally when central banks really get involved, because volatility in the Treasury market and gilt market, etc., is where things get really worrisome from a financial accident point of view. And I think all of that is combined over the last couple of days to send risk assets kind of into a tizzy, lead people into the U.S. dollar, which has just continued to strengthen and create a lot of uncertainty. And bottom line, markets hate uncertainty, investors hate uncertainty, and so they pull back and they don't participate. That means illiquidity, and that means sharper price movements, and that's really what we've seen over the last week or two.
Indeed, and Jay, Bostic from the Federal Reserve said today he doesn't believe a recession in the United States is a foregone conclusion. But James Bullard talked, well, he has talked today, but he talked yesterday too, and he talked about a recession in the US and a recession globally. And he said it was due to Ukraine and due to zero COVID politics in China. Which is your point of view? Because if we see what says Bostic or what says Bullard, the conclusion is not clear.
Yes, well, for sure, Martha, you're right. It's not clear, and it's not clear to investors. And it worries them that central banks, again, in the U.S. in particular, are raising very aggressively. And traditionally, rate hikes operate with a lag, right? So the Fed raises rates, but it takes time to feed through the economy and have its desired effect of slowing the economy and thereby slowing inflation. So there is that fear that if the Fed is going to continue to tighten aggressively, the risk of recession obviously rises, and that has an impact on appetite for stocks, because if you have a recession, then people worry about earnings. We continue to feel at TPW Advisory that we have a desynchronized global economy. US and Europe slow, Asia recovering. China is actually picking up speed coming out of its zero COVID lockdowns that occurred 6 months ago. So that's a positive. The PBOC, as I mentioned earlier, is cutting rates. That's a positive. So we think there's an opportunity for the global economy, at least, to avert recession. We think it's possible, given what's happened to energy prices in Europe, that Europe could enter a mild recession. But again, let's remember that unemployment is at all lows. Consumers have money, companies have money, and that's why haven't seen any kind of real financial stress of yet, because consumers, companies, banks, all are in very good shape. That's very different from 2008, 2001, etc. And then to the United States, we're of the view that the U.S. can skirt a recession. People say that the Fed is behind the curve, Yet if you look at inflation expectations, they're very well anchored. People say that the economy has to go into recession because the Fed has raised rates so high, but we are in a world of high nominal growth, something you and I have talked about before. And that is different than the environment from 2010 to 2020. So we think the US could avert recession, but a lot of it depends, as we talked about a minute ago, about how aggressively the Fed acts from here in terms of raising rates. I believe that the inflation numbers are going to start to look much better. Everything suggests that that's the case. Even now, rental leading indicators on the rent side, which is one of the biggest parts of the CPI, suggest that rents are rolling over in the United States. And if we get some decent news on the inflation front, that will allow the Fed to say, we want to pause here and look and see what one of the most aggressive rate tightening cycles in decades, in 40 years since the 80s, we want to see what the effect of that has been. But before the Fed can do that, it needs to have some decent news on inflation. And so that's what we need to watch for. PCE deflator next week, jobs and wages the week after, and then middle of October, we get the CPI. And let's remember, the Fed does not meet again until November. So there is time to have a situation evolve where the inflation outlook actually looks better than what markets are worrying about today.
Jay Bullard said this Tuesday, we must not recreate the volatile era of the 70s. Do you think, is there a risk of recreating it?
No, I don't think so at all. We're in a very different environment in the 70s. There was persistent high inflation for a number of years before the Fed decided to act with Paul Volcker in 1980. So there was a long period where inflation was in the mid to upper single digits. That's not the case here. Here we're talking about a post-COVID, post-government response to COVID surge in inflation, which is already rolling over dramatically. So I think one of the things the word I'm using a lot is extrapolation. Investors have been trained over the last year to extrapolate ever higher inflation numbers because they come in above consensus for pretty much the last year, and then ever more aggressive Fed. And that extrapolation has been the right thing to do up to now. I think going forward, extrapolating into the future, things like worrying about the 1970 type stagflation, inflation, I think that extrapolation is going to prove to be incorrect. We're much closer to the end of this inflationary little mini cycle than we are to the beginning, and there's virtually no evidence of stagflation, given that we have record low unemployment, which is not the case when you have stagflation. Stagflation typically is high inflation and high unemployment. There's very low unemployment across the developed world, so I don't really see the case for stagflation.
And Jay, tomorrow we will know the new data of the GDP, second quarter in US. What do you think? What can we expect? The same as we known before?
I don't really pay attention to the second quarter at this point, Marta, to be honest. We're entering the fourth quarter. I do think the third quarter is going to be kind of important. And there, based on the recent trade data we just got today, it's quite likely that the whole inventory impact on GDP, which has had a big impact in the first half of the year, that's going to reverse in Q3. And so it's quite likely that Q3 data is going to be better than expected. Q3 growth is going to be better than expected. And I think we've gotten a little bit of sense of that. And we'll see more once we have earnings, which will start coming out now in the next couple of weeks as well. And so I think the market is set up pretty well for what could be a powerful rally. It's been a brutal couple of weeks. And if we get decent Q3 GDP numbers, Q2, not really important, too far in the past. Q3, much more important. And I think that data is going to surprise to the upside, and that will support risk assets.
Thank you, Jay. And last question, which investment opportunities are you focusing on?
That's a great question, Marta. Sorry, I don't mean to laugh, but it's been so brutal the last couple of weeks that it's been very hard to find anything that is compelling. I think at this point in time, we are focused on the dollar and the dollar rolling over. Once the Fed ends its outsized rate hikes, that's really been our playbook. It's been very frustrating because it hasn't happened yet, and we've been affected negatively in our model portfolios that we run here at TPW Advisory. But at this point, as I just discussed, I think we're close to seeing the dollar peak, the Fed rate hikes peak, dollar peaks, and that sets off some real opportunities, I believe, across the commodity space, as well as the non-US equity space. And one area that's quite interesting is the emerging market economies. Typically in this type of an environment, emerging markets really hammered, and that has not been the case over the last couple of months. Emerging market FX, local currency debt, for example, has performed much better than developed market FX and developed market debt. I think we're maybe seeing the beginning of a sea change where emerging market actually starts to perform first in currencies, then in fixed income, and then finally in equity. And so we're looking to the emerging markets in particular as an area of opportunity as we go into 2023.
Jay Pelosky, thank you so much for this analysis.
Thank you, Marta. Great to be with you as always.
Pues nosotros